In today's episode you will be taught how to sell low and buy high. Oh, sorry, it was the Fed's narration, because whenever I just follow their decision process, I find there are lots of mistakes with long-term consequences. So today about avoiding those mistakes and about the most hot topic right now, that is inflation. Let's begin. And we are going to market movers section, and we will discuss over how the economic calendar looks for the yesterday, today and tomorrow. So firstly we'll jump into the 13th of July, and we had core CPI for the US dollar, and the measure, as we can find, was much higher than the forecast as of 0.4. Right now we have 0.9, and it's another one consecutive month that was higher in CPI than forecasted. So I would suggest that this reading that means that right now is stronger than forecast is definitely not supportive for the US dollar, because we have another 1 month of outperforming the prognosis, and this is not very optimistic for the US economy, as this gauge is getting a little bit out of control. Very important gauge was from the New Zealand, where central bankers has voted for or against increasing of interest rate of its bank, and we can find that regarding the threats that we may see this uprise, we didn't find any change. So right now it's as it was, 0.25%. It's worth noting that as short-term interest rates is an important determinant of currency valuation, we can find that regarding to this, traders watch this gauge very patiently in order to possibly change their investments decision. This time this gauge remained as it was. And we have just had the PPI reading, so month over month brings us the higher than expected measures, and we can find instead of 0.6 expected, there is 1%, so it is quite high. Right now we are just again over the expectations, and we can find that the PPI that may figure its figure has its in the role of maintaining price stability as getting over is getting also out of control, and right now in the one of the consecutive months we can find that the forecast is lower than the actual outcome. So it's not very optimistic for the US economy, and it brings us to the conclusion that the pace of inflation is very high. At 10 p.m. Eastern Time, all economists' eyes will be turned into Chinese GDP, because we have found yesterday that this measure will revolve around 8.1%. So this drop from 18.3% may be a little bit threatening, and we can find maybe that this gauge will be a little bit stronger than the forecast, so it will be interesting to watch. Tomorrow we also have initial jobless claims from the US, and what measures the number of people who filed for unemployment insurance for the first time during the past week. And we can find that also this is very important gauge in order to find how the Federal Reserve will try to tackle with the upcoming inflation, when the jobless claims will turn to be as Fed expected. There might be more voices for uprising of interest rates. On Thursday, we also have the Senate Banking Committee that he'll be delivering the semi-annual monetary policy report to Congress. And here you can find how the most anticipated earnings releases are turning up, and you can find we are right now in the banking earnings season. This week, by 16th of July, will be led by hedge funds and banks earnings readings. So it's worth watching definitely. Tomorrow will be Morgan Stanley. Today we have Bank of America, Citi, and BlackRock of the most important. And on Friday we have Carl Schwab and First Horizon. And we're jumping into market movers section and going to US inflation gauges. So this is a juxtaposition of the most important measures of US inflation, and we can find that the most skyrocketed import prices is right now at 11.3 level, but the core PPI that is at 5.3 and the core CPI at 4.5 are as high as it hadn't been for about couple of years. So we can jump into the next upside surprise. US core and headline inflation were both higher than expected in June, so it's exactly what we have been talked about. So right now the expectation is much lower than the exact readings, and we can find that the US CPI contribution of key categories has consisted the most of the transport and the oil prices, so that obviously impacts high CPI gauges, and that's exactly what I was talking about. We can find that core CPI is highest since July 2008 and November 91 regarding whether it's core CPI or headline CPI. And I highly suspect that those gauges will make committee members on the next congresses find dispersion by opinions whether Fed should start reducing its $120 billion a month asset purchases to ensure inflation doesn't burst into flames. And I guess they should finally take some steps in order to find this 2023 1.5 interest rate level. And there's another metric that finds how quickly US prices are rising. So right now we are watching housing affordability gauge surpasses 2008 level. So it makes us to find that unaffordability of homes is unfortunately increasing, and obviously for this case the best approach would be to stop further expansion of central bank balance sheets, and as a second step very slow increased interest rates over a long period of time, so that would be easing this skyrocketing chart. But made it happen this year? I wouldn't say so. And I also realized that all of the latest financial crack-ups in all Western countries was around housing. So right now it's very important to Mrs. Yellen and Mr. Powell to discuss financial risks of hot housing market right now. When it comes to indexes outlook, the most important chart for me today is SPX. So S&P 500 we can find is keeping very, very strong and opened at an all-time high on Wednesday, extending a record run from the previous sessions. So right now on the daily we are still holding this 50 EMA, this exponential moving average, and because of fear and greed index is still at a very, very low level, I do not really expect this market to move lots lower, because there are lots of cash on the sideline. So every single move back to this 50 EMA for us is a potentially good opportunity to buy. So all investments eyes are right now turned into the earnings season. Afterwards, we may expect maybe a little bit pullback. However, there are no signs of overheated market right now. And to the bullishness of S&P 500, we can find that if you would like to make history as a predictor of the future, we can find that SPX has never closed below for the year after logging double-digit growth in the first half a year. So we can find that this market, as expected, wouldn't drop at the end of the year to the lower levels than as it was in the beginning of July. So this level may be the lowest one for the S&P to end this year. And now we are entering crypto outlook section and get straight to this BTC USD chart, as BTC is the most important asset around the cryptocurrency sphere, and we can find where the BTC USD is going, the other alts will follow. So right now we are in this sideways movement, and there are boundaries at 41k and 30k. So there's very strong support at 30k, but in order to get back into an uptrend, we will need to get past through 41k. Right now BTC is in this period where it should decide whether it's going to the north or south. However, the major indexes such as SPX or US 100 rally. So I would suggest that especially for the beginner traders, not to take position in the BTC right now, because when the US 100 or the SPX will retrace, it will potentially drag down BTC, as it is part of the emerging market. So will be hit a little bit even more than possible hit of SPX of US or US 100. So as we expect the pullback in the SPX and the next major indexes, I find BTC USD quite risky to enter right now. And smoothly we are getting to the trade idea section, when we discuss over the most interesting for me chart of the day. So right now we are on the Global X Uranium ETF, accessible at CBOE BZX. So you can find we are in this long-lasting uptrend that has started on the second half of March 2020. We had on the way up two major breakdowns. I would say the first one has commenced at the second half of September 2020, and the second one was started on the beginning of January this year. Right now we have formed this head and shoulder pattern that indicates, following the technical analysis rules, that indicates the high possibility of trend reversal. So right now we have also broke through this trend line that also points us that we may get much lower. The technical analysis says that the possible target of head and shoulder formation may be as the distance from the bottom of this formation to the top of a head, and we can back just to this support at 17 US dollars. However, as there's lots of going on the global X uranium market, I would stay cautious. There are lots of positive news around there, and I would stay cautious and just regard and stay focused on the possible retrace to this area that was most traded during the previous time. So VPVR shows us there's a point of control where the most demand of this chart may be, and we can find that the possible retrace, if we just get below this 100 EMA, we'll find the possible buy opportunity at 18.8. So right now, just remember about the possible risk-reward ratio. Right now we can find, let's maybe draw it. Right now we are just here. The possible stop loss or the exit of a trade will be at 20.5, and just over these candles from 13 of May, and we can find the possible target is at 18.8. So this makes risk reward ratio at around 3. So it's very good possible trade. So remember about managing your risk, and it should be fine. So that's it for now. Thank you very much for watching, and see you tomorrow.